Super. Hello, everybody. We're back with the Tokyo FinTech podcast, and we welcome Benjamin Tsai today, who's the president and managing partner at Wave Financial. We had Benjamin on a podcast last summer, so this is a great time for an update. Welcome back, Benjamin.
Great. Thank you very much. Thank you for having me again.
It's very exciting. It's just been a few months. I think when we last met, it was very early in the formation of Wave Financial, and we talked about lots of things that could be done. And in the interim, they have happened. So, which is fantastic. Congratulations on all the progress.
Great. Yeah. Thank you very much. Yeah. So I think the last time we met, we had already launched an index product, really just providing market beta exposure to kind of the crypto markets. It's a pretty standard product. There are others in the market, but we just wanted to kind of test the waters with our version of that. I think on the call, we talked about crypto derivatives and the development of that market and a product around that. I actually spent some time and we developed a derivatives product, which we launched last fall after returning from Japan. We launched it in November and we've been able to pay out a yield based on Bitcoin. And that yield has been very attractive. We've been paying 1.5% yield every month since from the end of November on. And we've had new clients coming in every single month since end of November, and including this month, and next month we have clients lined up to come in also. So we're quite excited by the product itself. We're quite excited by the prospects of that.
So it's real things happening in the digital asset manager world. There were three things we wanted to talk about today. One is the last visit to Japan was in December, I think you said. So let's take a look at the outside perspective on the STO market, the securities token developments here in Japan. Second, take a deeper dive into that income product that you just mentioned regarding Bitcoin. And then lastly, of course, in the news that hit the wires over the last week is the whiskey fund that everybody gets tremendously excited about, tokenizing real-world assets.
Happy to go through these points. I'll start with the first one. I was actually in Japan in December, so I'd kind of made my rounds to the major financial institutions, and I was very glad to hear, and I actually visited some of the top law firms there also. So, spent some time with them, and the discussion is this. I think the laws in Japan are changing. They're supposed to kick in April 1st. Basically, I think the discussion is that the security token market will start, security laws will kick in, and tokens that are that represent assets, could potentially be done in Japan. My positive surprise was from the fact that there are a number of major institutions that are involved in this now. We're seeing really two major consortiums that are moving. Mitsubishi's got a consortium. They've got a number of Mitsubishi groups that are in there. I've spoken to a number of partners within that group, and it's quite exciting. They're very interested in it. They want to move forward with that, and so that's one group. The second group are the people that are in the JSTOA, the Japan Security Token Offerings Association. They're currently trying to get themselves to be the self-regulated entity for that space. And there are 6 securities firms in there, but a lot of major guys really trying to move that forward. I think there's Nomura, Daiwa, SBI, Monex, Rakuten, and Kabu.com. That's the 6 firms that are there. And they're really trying to push the idea of security tokens forward. And I find that very exciting. I spoke to, I want to say 3 out of the 6 players on that list while I was there. They all have high hopes for that. I think there's also kind of a third group that's kind of outside of these main people that are also exploring the different options. Won't get into too much details, but I think there is interest for others to get in that. I think the other interesting part to talk about really is, what do they want to do with this? What is the purpose of this? I think a lot of times people in FinTech get too involved in the tech part of it. They kind of forget they lose the plot. Why are we doing this again? So, I kind of cut to the chase and I asked a lot of the financial institutions, what do you want to do with this after, let's say we have the regulations, let's say you get everything up and running, and we talk about infrastructure in just a bit, but what do you want to do with this? And I think the very common response I'm getting, and to no one's surprise, are 2 major areas that really the Japanese securities firms have been actively involved in already. One is bonds, corporate bonds, fixed income instruments, and trying to bring that into the security token space. I believe there's an announcement today that Nomura Nomura Research Institute has launched 2 bond offerings on the blockchain. I think that is just the first of many of these that will be done. The sizes aren't that big. They were relatively small size trades, but I think they did that just really to flag in the sand, we're ready to start type of thing. That type of transaction you will see more of. some of the partners in Mitsubishi's consortium are actually not technology firms and at first or finance firms. I kind of wondered about that, and now I wonder about it a bit less because, well, every corporate issues corporate bonds, or every major corporate issue corporate bonds, and that's an interesting space. Different from the US, Japanese financial institutions actually do more business on the bond side than the equity side. It's actually a much larger part of their business, and therefore it's natural that that's the first area they want to tackle. The second one is actually very near and dear to my heart, and that's real estate. There's a lot of interest in wanting to tokenize real estate in Japan. In the US, that's been done, I would not say successfully. I think there's still some allergies with tokenization of real estate. Seller of real estate is really excited by the idea. They want to charge a premium for that. But buyers of real estate really are hesitant to do that. They expect a discount for being introduced some, different things. So there's a big gap between understanding there, and the American buyers of real estate just are not typically FinTech token buying type of investors. So that will still take a bit of time to adopt to, but at some point that'll come. I think that'll be a while longer. I think in Asia and Japan included is actually the next area that would be very exciting. Japan itself is not as big of a real estate investment environment, but if you look at kind of the other parts of Asia, China, Taiwan, Hong Kong, Singapore, most of the peripheral markets, everybody's a real estate investor. All the corporates are real estate investors and everybody's a real estate investor. And a good portion of that are also crypto investors. So they have some familiarity with tokenization of real estate. My guess is the adoption will happen faster in Asia than in the US, and Europe is kind of a question mark, but I would say probably faster than Europe also. Specifically with Japan, I think a lot of the securities firms are interested in getting involved in that so that they can be more actively involved on the real estate side. That's another asset class, I think, to a certain extent that doesn't have as much transparency, and different people who are not currently actively involved in real estate, like a securities firm or a bank, would like to be more involved. And having the whole security token aspect of it can potentially give them an opportunity to participate. So they're interested in that also. And personally, I just feel like overall, the Japanese real estate market, if it was to open up a bit, it would really free up a lot of capital within the country to move around. Japan is a very rich country, but a lot of that asset is just stuck as real estate on people's balance sheets. And that, if it doesn't move around, then the country just has no liquidity, basically. I think that's probably the easiest way to say it. And if more capital was to come in with tokenization, maybe international investors and so forth, that would free the money up within Japan to be maybe deployed in CapEx or investments in people or other things. And some of it will go overseas. I understand that. That's just the way it is. But overall, I think there will be more liquidity in Japan if more people are participating in the real estate market.
Fantastic recap of the situation here. You really focused on this market.
Yeah, so I do real estate investment here in Los Angeles, so I have some familiarity with it. Hard asset tokenization was something I'm interested in, and I really wanted to start with real estate. But I've realized that that's not a familiar concept, and the value that you add to it in America versus the work associated in trying to find buyers, I think the gap is just too much, and we decided not to pursue that. And I'll come back to hard asset tokenization later. So that's an interesting part. Yeah, one last thing I'll address on this particular point with regards to Japan and security tokens is I think there's still a lot of opportunities for everybody to participate in the growth of this space. I think the exciting part is the infrastructure in Japan is not quite there yet. In the US, we have a number of issuance platforms that are actively involved, and Securitize is now involved with Japan a bit more. But in America, there's not only Securitize, which we're an investor of. We are also an investor in Vertalo. We're an investor in a number of different infrastructure plays. There are a number of different, issuance platforms, and more are coming out every day. I think that's getting a little bit commoditized. And most of them, like Securitize and Vertalo, all have transfer agent licenses in the US, so they can actually be a recording agent for a transfer of ownership of equities and security tokens and so forth. Also, on the exchange side, in the US, there's Open Finance Network that's actively trading security tokens. Volume is not very high there, so I have no illusions that this is an up and coming space, but it is an active and running piece. We ourselves have a listing agreement in place with Open Finance Network, so we're quite excited about that, and they're already trade, I think, 6-7 different products there. Not only Open Finance Network, I think SharesPost was at one point trying to get into this. T0 has been active in this, although they've only listed their own token. We've been in conversation with T0. They're very interested in our products and so forth. And this is not only a US phenomenon. You're seeing that in Europe. We've spoken with a number of exchanges that want to get into digital assets. We're actively in conversation with a number of them in Europe. In Asia, you're seeing that also. Hong Kong announced regulations around security token exchanges in November, so there's potential growth in that. I know, somebody we work closely with, OSL, they've put in a bid for that. They're part of the BC group. And, they put in an application for an exchange. And I know others have also. In Singapore, there's iStocks. iStocks has done, I think, one or two offerings already. The last time I spoke to them, they're looking at more, kind of the rest of the year. They're looking at access to private equity funds, access to real estate. Not really a surprise, but that's where they're going. I believe there are one, two other exchanges that are coming out of the sandbox ready to get into this business. Compared to all of that I've talked about, Japan actually doesn't really have much ready yet. And I think that there will be a catch-up process. So I think that's all opportunity. It's great for all the major financial institutions to say they want to be in STOs and so forth. Great. They're going to need the infrastructure. They're going to need issuance platforms. They're going to need, security token exchanges. They're going to need to open that security token exchanges up for clients to be on there. There also needs to be custodian. A lot of custodians we speak to in the US, they're qualified custodians, they're licensed in the US. We're a registered investment advisor in California, so we're required to use registered custodians or qualified custodians. And in Asia, there just aren't that much. I know Nomura has a joint venture with Ledger. That could be parlayed into something. There was an announcement a long time ago from Mitsubishi Trust that said that they are going to start in custodying. So maybe, they can kind of dust off their software and maybe get that going. So there are inklings of things that can be done, but I think it's still early days. And that's, I think, what makes it very exciting. I feel like as long as the top financial institutions say we want to do this, and I've named a number of top institutions now, if the top institutions say they want to do this, then it's a matter of let's go build the bridges, let's go get the business done.
What is your view on the traditional exchanges in this playing field? Because if you look at Europe, for example, Eurex took a sizable investments in tokenizing, which is the equivalent of securitize in a way, right? So that maybe the first move of a traditional exchange group to also play in this space.
Yeah, I think that there are kind of a number of things. I think one area is, I think currently there is an old system that is being used for transacting in fixed income instruments and corporate bonds. The system is quite old. I believe it's like an old mainframe system people have used. They've been using it for quite a while. So from that perspective, I think there's an interest in upgrading it. But at the same time, nobody really wants to pay for that because obviously, upgrading the system costs a lot of money, and trading corporate bonds, the margins are very, very thin. Interest rates are low, spreads are low. There's not a lot of money to be made there. So I think with this particular round where, systems are being upgraded to be like blockchain compliant or going through kind of a security token setup, I think they are going down that path to upgrade those systems and so forth. So the original traditional fixed income system will probably be replaced by the newer systems that do this, and hopefully more efficient on the back end also. That'll save some costs that can cover the cost of implementing this. The funny thing is corporate bonds in Japan up to now are mostly traded OTC. So you pick up the phone, you call the broker, you trade over the phone. There hasn't been an electronic system built. So now is also a chance for them to add that electronic system to be able to do that. So those are things that will be happening on the fixed income side, which, as I mentioned before, will be the large part of it. On the real estate side, I think new markets will be built. There's currently not much of a market. There's kind of a REITs market that's traded through kind of the equities boards, but I think there would be a separate one built. In terms of kind of issuing security tokens to replace equities, at some point that could be done. I'm not sure if there's a burning need for it. And if the top financial firms don't have a burning need for it, it just probably won't get done. So I don't think it's a threat to business model for the existing stock exchanges, but I think it's an opportunity if they're willing to look at it. Actually. So if Tokyo Stock Exchange wants to get into this business, I'm happy to go help them out. I really feel like that there is room for them to grow into this and take that and run with it, as opposed to seeing it as a threat. It is an opportunity for them. And everybody is at the very first few steps in this space. So.
Go back to your comment on the technologists, especially in the blockchain crypto space, sometimes get ahead of themselves and there's this shiny new thing, but what problem are you actually solving? And it seems the advocates of decentralized exchanges or DEX fall maybe into that category. So I was curious about your view on decentralized exchanges in this context.
I think that is actually a great question. And I think I would tackle it in two different ways. I think decentralized exchanges on their own make a lot of sense. I don't currently like the idea of centralized exchanges that we use right now for crypto, where you send your crypto assets or cash to an exchange. It sits there while you're doing the transaction. When you're done, you then have to take it off. What I would like to do, and this is actually what we're building in the US, what I would like to do is I would like to keep the client's assets at a custodian. And the custodian, when you trade, the custodian would interact with the exchange. If you think about it in equities, in America, if you had an E-Trade account or a Schwab account, when you log into Schwab or E-Trade, they in theory hold your assets. I mean, the reality is there's kind of a back-end DTC system and so forth. Let's leave that aside. But kind of a representation for the retail client is your assets at Fidelity, your assets are at E-Trade. When you trade, you don't call the NYSE up. You don't call the NASDAQ up. You just tell Schwab you want it done and they go do it for you. And that's what I would like to see in the crypto space. You call your custodian and tell them, I want that done on, on Open Finance. I want that done on T0, and they go and get it done for you. The flip side of the whole DAX discussion is I think a lot of proponents of DAX are the people who are big preachers of you need to hold everything in your own hardware wallet. And that I'm less inclined to be supportive of. I understand that that is great, but in a zombie apocalypse, is your electronic wallet even going to work? I don't know. I mean, I think there are big questions there, right? So I would say that the security token discussion, and it's more of a cop-out than anything else, but it's easy to say. Security token to a certain extent is centralized at the issuer. The issuer owns a cap table of some sort that tells you what you own and what you don't own. The security token representation thereafter is really for operational efficiency. It's not for the sovereignty of being able to hold your own assets in a hardware wallet type of discussion. If the issuer does decide to overwrite the cap table, or the rightful owner claims that they've lost their wallet, the issuer in theory can rewrite and just issue them more security tokens as replacements. And that is to a certain extent the beauty of it being on the blockchain platform, but being in a issuer driven, ecosystem.
Understood. So let's move on to the second topic. That was the Bitcoin Income and Growth Fund that you launched in November.
Yeah, sure. I'll start the conversation really more on our belief is that the derivatives business is going to grow. I think we talked about this, last June when I was on your podcast, and the discussion was simply that I think that the derivatives business will grow. Derivatives, typically people refer to the futures business. I'm a little less interested in that. The futures business is just a discussion on how you could take a position without using all of your capital. It's kind of a leverage trade type of thing. To me, I find that a little less interesting. There's not as much I can do for the end investors by that. I can get them more leverage is not something I'm pushing to do. What I do find more interesting is more on what we call, call options and put options, which change the cash flow of underlying crypto. Right now, it's still a relatively nascent market. It's probably been up and running for about 2 years or so. People are trading mostly Bitcoin options and nothing else. The bulk of the volume is still done at Deribit. Deribit is an exchange originally in Amsterdam. They've recently moved to Panama as the beginning of this year. I'm not sure how much they've moved up in the properness of their jurisdiction by moving to Panama, but we were asked for more AML KYC documentation, which we provided. So, maybe they're doing a bit better there. They've done a raise. They're making good money. Good volume goes through. I feel relatively comfortable trading with them. And that's the bulk of our venue. I believe OKEX comes at a distant second in terms of volume of Bitcoin option trading. They just recently started. And, there are some US exchanges that have offered that also, CME, BAC, and LedgerX. LedgerX has some tiny volume and getting worse. BAC, we've been speaking with about seeing if we can access that liquidity pool, but it's extremely difficult. They needed us to open an account with them. They needed us to open an account with their custodian, which is DACC, a business that they bought. And they need us to also open an account with a clearing house, EFG Man or Wedbush or somebody that will give us a credit line and represent us at the exchange. It's a very traditional way of setting things up. Basically, those guys are stepping in to provide a buffer of risk so the exchange doesn't take on any risk. And because of that, the EFG Mans of the world, the clearinghouses in the middle want to charge us a lot and want to have minimum volumes that we're going to put through because they want to make sure they earn a certain amount for lending their balance sheet for this. All of this discussion to me sounds like, really traditional finance being applied to something that's almost irrelevant. Obviously the trades we'll be doing, we'll have collateral for it. We're delivering the collateral. For example, with the Deribit trades, we're delivering the collateral to Deribit. Credit risk on Deribit aside, we're fully collateralized. There's really not much of a discussion of I need a clearinghouse in the middle that steps in and provides credit lines for me or margins and so forth. The U.S. exchanges are not doing that well. The growth in volume isn't really quite there. Will it not grow in the long term? Yeah, it'll probably grow in the long term, but I'm putting a lot of faith, on that, or we're not relying on that very much. In terms of the derivatives we're doing with Deribit, Deribit currently supports Bitcoin. They have a little bit of ETH, listed ETH options also, but it's mainly BTC. And, we do our trades there. Interestingly enough, there's a completely different company called Paradigm. They've built basically a chat program that's integrated into Deribit. And you can have a discussion with Paradigm with other OTC counterparties. You negotiate the price and you decide that you want to trade. And once you decide, the trade itself actually gets booked and goes through the Deribit system as a block trade. So that's very interesting. And that's what we typically use because of our size. We typically just put in a number of blocks through and get our trades done there. And they'll show up on Deribit as a block trade. There's a little mark that shows their block trade. That's kind of interesting. It's very different from just going on the exchange and picking off little bits and pieces of option there. So from that perspective, that's starting to get a little more developed, a little more advanced. And that's what you typically see in the traditional markets where you call up a big broker, your Merrill Lynch or Goldman Sachs, and say, look, I've got a big chunky trade. I'm Fidelity, I got a big trade. Let's get that trade done. And, they kind of arrange that behind the scenes with potential buyers. And then once you get it lined up, it does print on an exchange, but it's done not on the exchange. So we're starting to see development there, and I find that quite exciting. And with that depth of development, we've decided to launch a product last November that basically is a yield product for people holding Bitcoin. It's called BTC Income and Growth. We're trying to mimic funds in other markets, in equity and fixed income markets that have both a growth and an income aspect to it. Bitcoin, if you just hold it, there's really no other stream of income. And I think by us creating a fund that pays out a stream of income, we could hopefully provide something different that the clients may want. So we set it up where we basically, if clients can contribute in cash or in Bitcoin, and basically we take that on and we put that into our fund as Bitcoin. So if you give us cash, we will buy Bitcoin. If you give us Bitcoin, it'll just come in as Bitcoin. And we hold a pool of Bitcoins for you. That's the exposure. If it goes down, you're going to have, same number of Bitcoins is going to be worth less. And that's the full exposure on the downside. On the upside, what we're doing is we're selling call options that are away from the spot price. And we sell it once a month. We'll sell call options, and the call options will generate a premium. And that premium we're paying out to clients as dividends. We have a target rate of 1.5% per month. So we're paying out 1.5% of whatever your investment is at the beginning of the month every month. And that's equivalent to an 18% per annum product, which is very attractive compared to what you're seeing right now. And this is not really currency dependent. We didn't make a yen version, but we could have. And the yen version would still pay 1.5% per month because I'm not depending on the Japanese, yield curve to generate that return. So from that perspective, it's a very interesting. The yield itself is quite high. And what is the downside to the call option selling? And that's kind of the key point. We typically sell 20% out of the money options. So let's say Bitcoin is worth, a certain level. It would be 20% above that we're basically setting a cap. So within that month, if Bitcoin rises, but rises up less than 20%, that's fine. Clients get all of that. If it rises above 20%, the clients get everything up to 20%, but no more than that. So that's what they're giving up. And on a monthly basis, I'm leaving 20% headroom. And if you compound that over a year, I've actually left the clients quite a bit of headroom. So there will be months where Bitcoin will spike, like it spiked in January. We captured 20 out of, I think, 26% of the gains. We didn't capture all of it. We had captured 20 out of 26. And we paid 1.5%. So, you lost 4.5%. And loss is not even the right word. I mean, you gained, 21.5% as opposed to 26. That's just the way the structure is. In other months where Bitcoin was not rising up more than 20%, you're getting the full upside. And we've paid 1.5% coupon for every single month since, from the end of November on. From a structure perspective, I believe that it's quite attractive. It's interesting. We've had good client demand. We've had clients come in every single month, from the end of November on all the way through. And, we took money in at the end of March, which is just right now. And then we'll be taking money in at the end of next month also. We already have, clients who they've signed their paperwork, they're wiring us their money. We're quite excited by the product. We think it's something interesting. It's something that we're able to provide the clients that's not currently available elsewhere. And it's taking advantage of this new market that we're in. As one last point, volatility has spiked up significantly in the past month, as everybody probably knows. So with that spike, what we're doing actually is premium that we generate after we pay out 1.5% and our expenses and so forth. Any excess that we have, and we'll have excess because vols are high this month, we're actually reinvesting back into the fund. So we take a performance cut and the rest we invest back in the funds. We're actually buying more Bitcoins for that pool. So everybody owns fractionally more in that fund. I think that that's also another attractive feature, whereas when volatilities go up, there's more returns to be generated. Volatility this month has been so high. What I've actually done is I've sold calls actually slightly above 20% to capture a little bit more headroom just in case it bounces back. And at the same time, I'm able to pay out that 1.5, and also I'm able to reinvest more into the fund. So all in all, it's good for the investors who are in the fund.
Super. And you mentioned volatility. The other aspect is also the correlation with other asset classes. And your colleagues put out an interesting article on that over the last week as well. Obviously, similar to the global financial crisis 11, 12 years ago, correlations in a distressed market tend to go to one, right? And so on the way down, everything moves at the same time, which in your view, based on that article, doesn't invalidate the thesis that Bitcoin largely is an uncorrelated asset to existing asset classes. So that's where you're making the argument that diversification benefits of Bitcoins are still there.
I think it's a complicated discussion in the sense that I think it's easy to say, well, the market's down 3 days and Bitcoin's down 3 days, and therefore this correlation has broken down. Correlation is typically calculated over a much longer period of time. So I'm not ready to write off Bitcoin as a correlated asset class. Our paper was written on a more general basis with regards over longer dated time frame in terms of correlation and so forth. And I think over a longer period of time, the correlation does diverge. Bitcoin kind of does its own thing. It goes up and down on its own whim more than anything else compared to the traditional markets. Now, I see a potential discussion being in a very crisis market, in a market where everybody needs cash or everybody wants to be in cash as opposed to being exposed to any assets. They will sell everything that they have in any asset class and go to cash. And in those circumstances, which I believe is what we're seeing in the past month, Bitcoin and every other asset class and gold and equities and fixed income, everything gets sold. And in those instances, your correlation will get close to one. They will all correlate in the same way. They will all go down. And that's the unfortunate reality. I don't think there is a magic bullet that is there that exists that you will get, short data correlation that to be negative. Over the longer term, I do believe that correlation will be, will diverge again. We're starting to see a little bit of that divergence. And once again, I don't like citing, 3 days worth of data to say, I was right or I was wrong. It doesn't really make any sense either way. I would say if you look back on the financial crisis last time, when the financial crisis first developed, everything was sold off, including gold. But gold actually started to diverge from everybody else the moment people are done liquidating all that they want to liquidate. When they're ready to pile back in, the people actually pile back into gold earlier, and therefore their correlation decoupled first and moved away. I would like to think that Bitcoin could potentially do that. I can't guarantee that. And decorrelation meaning going the opposite direction, that may even be worse. I don't know. But I would believe that correlation will not hold up as much as once we come out of the panic, let's sell everything market. The panic, I sell everything market, the correlation is one for everything. I don't disagree. I don't think there's a way around that. And, I think people who are trying to make a case otherwise, I think, it's very hard to make it otherwise.
Agreed. Thank you for the explanation. Now, drum roll, the hot topic of the week is the whiskey fund. So it comes back to tokenizing real world assets. And this is truly something that has never been done before. What's the rationale and the business case for tokenizing whiskey?
Sure. Let me kind of go back to what we were talking about before. I'm very interested in tokenizing hard assets. I think it's a great way to be able to trade hard assets, to have it in token format. Tokenization increases the efficiency of being able to do something and makes costs go down, and therefore you're able to fractionalize. So it's economically feasible to handle much smaller bits and pieces of it. So from that perspective, I think it's very interesting. So when we first started down this path, we were thinking about what can we fractionalize, tokenize, take advantage of blockchain technology, because that's something we have intimate familiarity with. And we're also invested in a lot of the infrastructure, and we really know the infrastructure very well. we've also tokenized the two funds that I've mentioned before, our income product and also our market beta product, our index product. So we understand what that means. We've paid our lawyer bills for, for all of this. So we thought, okay, so now we know how to tokenize. What else can we go tokenize that would be interesting? We saw two things that were being done in the market. One was real estate. As I mentioned before, that wasn't working really well. People weren't quite comfortable with it. The other thing that has been tokenized quite a bit, there are a lot of VC funds that have been tokenized. Spice VC, 22X, and so forth. They're all VC funds that are being tokenized, and there are more coming to the market also. And the discussion is always, VC funds, because there's no liquidity between now and when everything gets redeemed, let's tokenize it so people can get liquidity. Conceptually great, noble cause, let's go do that. The issue is people don't really know what the value of it is in the middle. So how do you trade that? What do you base that on? How do you figure that out is a difficult thing. And they publish, audited NAVs once a year. They publish NAV maybe a little more often than that, but not really. And it's difficult to tell what's in the portfolio, how much of it you own, and how to value that. Now, can people trade that without knowing how much it's worth? Yeah, they could. You could take a guess and buy it. If you think it's cheap, buy it. And then if you think it's expensive, you can sell it. But, it's hard to get people comfortable with that. Anyway, so I think we didn't want to go down that path. So we, for the two funds that we've built, we're trying to provide, indicative pricing as often as we can. We have monthly NAVs. We're very clear as to what we're holding, what we have, and, versus what we have, you can figure out what's happening with the fund. So now down to kind of really the hard asset path. And, we didn't want to do real estate. And so we were looking for something else that is a good, solid investment product. At the end of the day, we're an investment manager. We want to provide good investment products to the clients. It's not just about, I'm going to put on a blockchain and make the tokenization interesting. That's not what I'm trying to achieve. A fiduciary to my investors, I want to bring them something that they can make money on, tokenized or not. I mean, that being the number one priority. So we were looking around at a number of different assets, and we've settled on tokenizing American whiskey. It's an odd choice maybe, but it's something that as we were looking at different assets, I was speaking with corporates that were looking at Japanese racehorses. I've spoken with people that want to look at solar panels. So those are things that throw off cash flow. We've talked about collectibles. Our CEO David Seymour knows someone who owns a good collection of Picassos. Do they want to tokenize a fraction of that? So we were looking at different things, and in the end we decided on whiskey because it was something that was easiest for people to understand, and the return profile was extremely good. When I first heard about it, actually, I was a little bit surprised by the return profile. So I actually, got on a lot of conference calls. We actually flew out to Kentucky. I've been in Kentucky, 3 times in the past 4 months to really talk to the distillers, the consultants, the advisors, the brokers, the lawyers, the Kentucky Distillers Association, and pretty much anybody, that's willing to talk. And, we were invited to a party at the governor's mansion and, mingled with all the people kind of in the industry and out of the industry, all the financial institutions that support the industry and so forth. What we found on a very, very simple basis is we can buy a barrel of American whiskey, freshly made, at day zero for less than $1,000, including storage costs, including taxes and insurance and other things, and our fees. Let's call it $1,000 to buy that and hold it for 5 years. In 5 years, that barrel of whiskey is worth about $3,000 to $5,000. And that's a conservative estimate. We've heard numbers that are higher. As long as it's a decent barrel of whiskey, we've heard higher numbers. But let's just take that as a conservative number. If you think about it, that's an extremely good return profile. You're talking about 3 to 5x in 5 years. And the beauty of this, which is different from VC, is, and a VC, some VCs are, I make 10x, I make 100x. They make 10x, 100x on, let's say, 1 out of 10 companies, 2 out of 10 companies. I'll give 3 out of 10 maybe. Okay. Our barrels, all the barrels are worth $3,000 to $5,000 in 5 years. That is something that I found very, very compelling. We're also, because this is relatively commoditized, it's new barrels of whiskey, we're also able to buy insurance at a reasonable price. These are not collectibles. There's a replacement value to it. If somebody was to drop it, or, this has happened before, but if the rick house where they keep all the whiskey, if the whole thing burns down, unfortunately this has happened before, you call the insurance company, you get your money back, right? So that is a very compelling thing for me also. So our idea and our fund that we're putting together right now is simply we're going to buy fresh American whiskey from a distiller that we are teaming up with called Wilderness Trail. They're an up and coming distiller, and they're great. They're one of the top distillers in Kentucky, and we're going to buy 10 to 20,000 barrels of whiskey from them, which is equivalent to 2 to 5 million bottles of whiskey. And we're going to put it in storage, and we're going to hold on to it using our investors' money. And then we are going to start selling it probably from year 3, 4 on, and maybe sell out the whole collection about year 7 or 8. We believe that around year 5, we're looking at an IRR of over 20%. I think that IRR, is stable across, the bulk, 5, 6 years with no issues with our conservative estimates, with all the costs and everything thrown in. And we could probably do better than that. I think that's a pretty conservative estimate. The market itself is relatively liquid, pardon the pun there. But basically, there is a market for the barrels of whiskey after a certain time. We could sell the barrel of whiskey back to Wilderness Trail, the original distiller. Obviously, they know what's in the barrel. They're pretty comfortable. They're buying their own product back. The second area is we can sell it to other distillers that maybe at a shortage and they need some. We could sell it to non-distilling producers. They're called NDPs. There are a lot of guys that are making whiskey with their label on it, their marketing and their blending and so forth, that don't age whiskey. They just buy the whiskey that's available, blend it together the flavor they want, slap their label on it, go do the marketing and sell it. And the non-distiller producers will buy the barrels. And also a lot of European makers and some Asian makers come through and buy the barrels, bring it back to their home country, typically in a tanker, and then they bottle it themselves, put their own label on it and sell in the market. The biggest export market of American whiskey is actually Spain. The second largest being Japan, and the third largest being Australia. So those are the 3 big export markets, and including America being obviously the biggest market, it'd be, 2, 3, 4, I guess, would be the top markets for this. So that's kind of an interesting, aspect of that. And the final channel that we could sell them at is to enthusiasts. Enthusiasts a lot of times will show up at distillers, do a tasting, and buy them by the barrel. Now, you don't sell many barrels through that. You sell 1, 2, 3 barrels, unless but those barrels on a retail basis sell for very high pricing, $10,000, $12,000. And, it does come with some other costs. You got to entertain them and do the tasting and so forth. And afterwards, they typically want it dropped into their bottles. So you got to pay for the glass bottles and so forth. But that's, very minimal cost when you're selling at twice your estimated value of your whiskey. So there are some channels to let go of the inventory. So that's very exciting for us. And at the end of the day, these are not collectible. These are commoditized 3 to 7 year old, aged whiskey from a top tier distiller. So we're pretty comfortable there. The bottleneck we found when we first started research was that most people do not have the capacity. This has been a great market for American whiskey for the past decade. And, it's been great for all whiskeys. You've heard Japanese whiskeys they're gone. Like they've drank all that they have. Whatever you're going to get is what's coming out next year. Scottish whiskey has gone up in value quite a bit, and American whiskey has also gone up in value. Not as much as Scottish whiskey, but it's up and coming. And, over the past decade, the returns have been very good. Because of that, you can't walk into Kentucky with a bag of cash and say, hey, I want some barrels. They've just, all the production's been allocated. So we had to spend some time networking with people, and our advisor actually found us that relationship with Wilderness Trail, who happen to have had some extra capacity that they can give to us. They're going from a 5-day production cycle to a 7-day production cycle, and we're getting some excess capacity they have from that conversion. We feel very lucky, a top tier distiller being able to offer that to us. It's great. I've spoken with people from Jim Beam and so forth, and Jim Beam's owned by Suntory. Jim Beam, basically, they do not sell their barrels to anybody else. They go all the way from their barrels to their bottles, and they sell the bottles. And they don't buy barrels from the outside either. They're to a certain extent a closed ecosystem, which is similar to what my understanding of the Japanese whiskey market is also. So we've been able to secure the capacity. That's something that we're proud to say, and that's why we've decided to launch a fund there. As the last point, which is more relevant in the past month because of kind of the markets really falling apart, we've been looking at historical pricing of whiskey and so forth in crisis situations. We thought that's good to have. We actually have market data, which I can forward to you later on, that markets were very resilient for whiskey during the financial crisis, around the financial crisis. So 2008, American whiskey pricing, both by dollars, by volume, were up. 2010 up, 2011 up, and every year thereafter is all up. The only down year they have in my chart is 2009, which really is a reflection of the financial crisis. They were down by a dollar amount, they were down by 1.4%. By volume, they were down by 0.7%. So yeah, people kept drinking. So the recession didn't hold anybody back in any way. And I think people are, very comfortable with 1-2% drop in value, from that perspective. Because at the end of the day, every other asset class you're looking out there has dropped more than 1-2% in the past month.
And this financial crisis is slightly different because we're all in lockdown, and anecdotally, it seems like the alcohol consumption is spiking currently.
Ah, okay. I'm actually not surprised. It's not really an anomaly because we also looked at other data. Scottish whiskey, their sales were up in 2000. So, we're not surprised that that's the case. It's very resilient. It does well. And what we saw during the financial crisis as we were doing our research was that people were switching from drinking at bars, which has a higher markup, to drinking at home, which has a lower markup. But for alcohol producers, the pricing is not very different. It's different margin, so the bars made less margin, right? And you're probably going to see that in Japan, and you're already seeing that in the US. A lot of bars and restaurants that serve alcohol, they're closed because they're not allowed to do business. I was at Bevmo, which is one of the big liquor store chains here, to look at the different alcohol. There was a long line, from the crisis, and people were stocking up. Just, you have a shopping cart, American-sized shopping cart full of wines and alcohol and different things. So yeah, so the sales is not going down for alcohol in this market.
My question was a bit on the distiller side, because there is this very predictable increase in market value. It comes a bit of a financing question, right? Cash flow question. If I can finance that throughout this 5-year cycle, as a distiller, I could capture all the upside myself. So why would I give this away to a fund like yours and basically just become a servicer for that asset by storing it? And maybe part of the answer was when you said that they have excess capacity that is now easy to commercialize, monetize. But from that perspective, it seems a fairly limited market, because as long as, the interest rates are near zero and you can finance this 5-year cycle of inventory to get off the ground, even as a new distiller, you wouldn't need to give up the upside. Or am I missing something?
No, I think you've asked a very good question. I've gotten this question from a lot of people. We actually are looking for financing also, just see if we can juice up our return. We were speaking with one particular fund that does this type of lending. The rates are quite high. It's 2% for origination, 2% for early prepayment, and 12% interest rate. So yes, there's money available for borrowing. It's not cheap, right? Even in this environment, there's money available to be borrowed. The other point is that for a distiller, it's not just about distilling and then you close up shop, you turn off all your machines and you wait for the whiskey, right? You want to continue to have your staff continue to run the distillation so that you have further inventory. And to keep the doors open, to keep the staff and so forth, you need to have short-term cash flow coming in that will pay the staff and so forth. So when they first ramped up their distiller, they were actually, distilling a little bit of vodka, and they were selling vodka because there's no aging with the vodka. You basically distill it, you can sell it pretty immediately. So they were doing that for cash flow. They actually won some gold medals for their vodka, which they no longer produce. It's kind of an ironic thing, but it's something that they were doing on the short term just for cash flow. And right now, as just a funny side example, they're making hand sanitizers because the hand sanitizers they make is 80% alcohol. So they're alcohol experts. They know how to make alcohol. They're making hand sanitizers. In this market, that's what's needed, and they're kind of pitching in to help out. And they're selling it for money. They're not doing it for free. But it keeps the door open, it keeps people employed and so forth. So it's a positive thing. And the other way of looking at it is, for the amount of balance sheet they have, they've maxed out their production, and they've maxed out, when they built the plant, they were maxing out their credit, and they continue to max out their credit by putting more inventory aside and so forth. For what it's worth, they have already used up the bulk of the credit line that they have. And as I mentioned before, it's not cheap credit line. At 12%, it does become a burden from a cash flow perspective. The interest payments start immediately. This is not there's no delay in payment there. If you took out a 12% loan, you do need cash flow from that perspective also. All in all, there's a limit to what a distiller can do. And in excess of that is excess capacity. And that excess capacity, by offering it to somebody else who will pay them for the work of distilling, they're going to have a good cash flow coming in using equipment they already have.
Interesting, in the Nika whiskey origin story, when they started up in Idaho with a distillery, similar question of how do you generate cash flow in the interim, and they actually produced apple juice.
Oh, interesting. Great. Okay.
On Suntory, you mentioned that they own Jim Beam, and there's a shortage of the aged whiskeys. And Suntory, at this point, is the only beverage company that owns a distillery of every type of whiskey there is, including Irish and Scottish. They launched a new whiskey that's a blend of all these types. Quite honestly, I think it's also a play on blending younger whiskey because the aged stuff is just too scarce to.
It's interesting in the sense that they're able to blend all three together. I would wonder, what they're blending together, because obviously American whiskey is typically over 50% corn,
Yeah.
whereas, Scottish whiskey is more barley. And, do you blend that together or make American barley whiskey, which you could, or do you actually add rye, which is a completely different American style whiskey where it's over 50% rye? And it's interesting. It opens up a lot of different experimentation, different things. But yeah, I completely agree with you. It's difficult to find, deeply aged products.
Super. Huge amount of things happened over a very short time period. Again, perfect execution. Congratulations to that.
Thank you very much.
Of course, you're setting the bar very high. And so the natural question is what to happen in 2020 for the plans that you can disclose?
Sure. I think we're focused on really getting this fund launch. We're going through kind of fundraising, and I'm working with lawyers on paperwork to get the details done. It's always important to make sure the details are done properly. I think for us, it's more important to get a few right products done than to get a lot of different products done. But once we're done with this, I think, are there any other assets that we can tokenize? Certainly we can do a 2021 vintage of the whiskey. That production capacity, after they make it for us, they still have that excess capacity for us, so we can do it again and again and again if there's demand for it. We can also look at potentially doing other asset classes, other alcohol. We go back to doing collectibles. So I think that discussion of Picassos, I think that's potentially interesting for people that want that. I personally am not as much of a fan. I don't know what it means to own a fractional Picasso. I mean, it's not going to hang on my wall. What is the point? But I guess we can make fake ones to send to all the token holders or something. We're looking at different things also. I think that would potentially be interesting. Certainly that's on the hard asset tokenization side. On the derivative side, we're very excited about kind of the build out of Bitcoin derivatives. We're actually speaking with other people to try to see if we can build out, a lot more on the derivative side. I'm developing a way of settlement to reduce kind of some of the counterparty risk. Really a labor of love. I don't think we're going to get more business done because I'm doing this, but it does reduce client risk, and I think that's worthy enough for me to spend my time on. So we're working on that to reduce counterparty risk on the collateral side. And once we get that done, we would love to do more bilateral trades with a lot more, OTC counterparties, and kind of get this field a lot more excited. So those are kind of the two main areas I'll be focused on after I get these main products out the door. Just as an aside, I think the next thing we are going to do is we're going to build out our distribution channel. I think it's great to have good products, but we also need to make sure that they're getting to the right hands, and that's what we want to do next. So we're currently in a fundraising round for our parent company also to try to get that going, so that once we do that fundraise, we can then build a global kind of distribution network.
Wow, thank you very much, Benjamin. When we set out here, we thought, well, we'll cover 3 quick points and be done with it. But the conversation is always so deep and so detailed and insightful. It's been a pleasure again. Thank you very much for taking the time.
No, thank you for having me.
And stay safe, stay healthy in Los Angeles.
Great. Thank you very much. Thanks for your time today.